subscribe now and press the bell icon. Never miss an update.
So let's go to the next point, insurance expense. Insurance expenses are usually all deductible and all. There is a slight difference between cash method and accrual method. Cash method needs to make sure the payment has been paid out, and but still we cannot take it for more than the time that it covers. So it's more like prepaid rent. It must be apportioned over the period of coverage. Then there's something called self-employed person. This is called self-employed health insurance deduction. It's one of the line items on 1040. So if the person is self-employed, meaning if they have Schedule C, then they can deduct the entire, health insurance premiums that they're paying for the family as well. So let's, who can read this, Bhavani?
Yes, ma'am. Life insurance expenses. Harry provides his employees with group term life insurance. Yes. Harry provides his employees with group term life insurance equal to their salaries. In year one, Daniel, an employee, has a salary of $80,000. Daniel is 40 years old. So the monthly cost per $1,000 of protection is $0.10. Daniel includes in his income premiums for $30,000, that is $80,000 minus $50,000 excluded, of the group term life insurance, which equal to $36, that is $30,000 divided with 1,000 into $0.10 into 12 months for the year.
So basically, if any of you remember that there was a clause that we read earlier, that if the insurance is given, then up to the coverage of $50,000, it will not be getting added to employee's income. But any coverage that an employee gets above $50,000, and if the employer is paying premium for that, it needs to be added as an income. So what they're saying is he has to include in his income premium some $36 and all, because up to 50,000 it's employer can pay for all the expenses and there's no perquisite to employee. But after that, the employee has to pay. And it's the cost of, this is something we see in India also, that for 1 lakh rupees of protection, maybe you need to pay 1,000 rupees or something like that. So that's what they're saying. For every $1,000 of coverage, they need to pay 10 cents. And this is for group term life insurance. So when the employer is providing group term life insurance and the coverage is more than $50,000, we need to make sure it gets added as a perquisite. Bad debts, yes, bad debts is allowed. If you're an accrual basis taxpayer, it makes sense to even deduct bad debts as an expense. And later, if you recover that up, we need to add that up as an income. But if the books are on cash basis, there is no question of bad debts, right? Because we are not even taking that as an income in first place. What is a business bad debt and non-business bad debt? Business is obviously accounts receivable or customer payments which are not coming in time, or which are basically not coming at all. And we know that the probability of getting paid is very, very less. So that is all considered as an ordinary loss. It's a regular expense item. But if it's non-business, we have to see what is that for. If it's an investment that goes bad, mostly we will take that as capital loss. But there's if there is a security that the person has invested in and it is partial worthless, you cannot claim that as an expense or as a loss. It has to be fully or wholly worthless. We need to get some kind of letter in writing or something that the company is completely bankrupt. There is no chance of getting anything back. Then only you can take it as an expense or as a loss basically, or as a deductible item. But that's not the case in business bad debt. As long as there is a probability, a reasonable probability that we cannot recover this amount, we'll take that as a bad debt. It's quite possible after a few years, we get this money back. At that point of time, you need to make sure it gets added as an income. So let's 1 minute. Business bad debt. Can you read the example here? Somebody, can you read the example? Vandana 3.12.
Yes. Peter is a cash basis taxpayer in the lawn care business and charges clients monthly. One of his clients stopped paying and built up a $500 bill before moving out of state. Peter is not able to deduct the bad debt because he is a cash basis taxpayer. The unpaid bill is never included in revenue, but Peter may deduct any expenses for providing the service and attempting to collect the debt. If he was an accrual basis taxpayer, the only difference would be that gross income and bad debt would both include the unpaid $500 bill that was written off.
Yeah, so can you explain this? What exactly is happening here?
Yes, ma'am. Ma'am, since he is a cash basis taxpayer, these like unpaid bill will not be included in the revenue because it is not actually paid. And then if he was a accrual basis taxpayer, then it would make a difference to that because invoice would have been recorded on the accrual basis, and that way he can report the bad debt.
Yeah, so I hope it's clear to everybody. I'm not going to spend too much time on it. It's very, very, uh, you know, there's nothing technical here. There's really nothing, very complicated here. If it's a cash basis, you should be knowing what to do. If it's accrual basis, we should be knowing what to do. Okay, let's not spend too much time here. Can you, Vinita, continue reading business versus non-business? And please pay attention, okay, what you're reading. It's not like you're reading for the sake of it, and then
Yes.
if I ask you, then you probably read it all over again. That's not the point.
Ty is the sole proprietor who designed custom skateboard. Last year, Ty discovered that he will only be able to collect $100 of a 500 loan he gave to a supplier for business reason due to supplier's insolvency. This is considered as a business bad debt. Thus, Ty may deduct the worthless portion of the debt or $400. However, if Ty made the same loan to a friend for personal reason, he would not be allowed a deduction. A partially worthless non-business bad debt is not deductible.
Okay, Tanya, please explain.
So basically, he loaned someone $500, and he realized that only $100 can be recovered from the supplier. He can actually record the whole thing as $400 bad debts because it's actually worthless portion, and the whole expense was for business. However, if he had given this on his personal basis to a friend or family, then he cannot record that as bad debts in the business part.
Yes, good. So the point is whether it's a business or non-business, we need to understand that. Somebody comes and tells you, oh well, this is a business I'm running. I have to get $10,000 from somebody. It looks like I'll not be able to get. Maybe we'll get 50%. If it's accrual basis, take that as a deduction. Other scenario, someone comes and says, I invested in a startup, some $10,000. I don't think I'm going to get anything back. It's just a dead investment. Please claim it all as as a capital loss and all. We have to ask the person what, like, it needs to be 100% worthless. There has to be some kind of bankruptcy filed. There has to be a dissolved, and the entity has to be dissolved. There has to be a letter that you should get from management that, okay, fine, you have given this much, but we are not in a position to give anything back. So it's a complete 100% loss. Unless otherwise, if they don't give it and the company is still running, you need to wait for it to be completely liquidated. Okay, otherwise, if IRS audits it, they may go ahead and they may say that, okay, we are not giving you this deduction anymore. Okay, because it's a non-business, the rules are very strict. Otherwise, people will keep giving loan to their friends and say, oh yeah, I have given this much to this and all, my friend or relative and all, and they're not paying. So, or maybe after a few years they get it, somehow they take it back and all. So IRS has to be a bit strict, but when you're running business, as long as there is a reasonable probability you not get it back, you can take that as an expense. There's something called specific write-off method, generally used for tax purpose, and this is only for specific write-off is what is that you're going to write off, what exactly is not receivable, use that. Reserve method, when we put a bad debt reserve or like a allowance for doubtful debts, this is the language that we always use, right? That's used only for financial accounting purpose. That could just be an estimate. That is more on the finance, like more from financial audit point of view, that the auditor has to have a reasonable allowance set up there, or the management should be very conservative and all, and by saying that, okay, we probably have to put a 20-25% allowance. So that's the industry practice. But when it comes to tax, we cannot be that conservative. Now here the being conservative is like you're going and you cannot claim deductions very aggressively, because it's a loss of revenue for IRS. So they are not going to we need to be very specific on what we are writing off. We cannot just take a simple reserve method that, okay, take 10% of everything, take 20% and put an allowance there. So this is the difference between book basis and tax basis. Worthless corporate securities are not considered bad debts. Yeah, they obviously worthless securities and all those are all investments. They're not bad debts. Bad debts, when we say, they are usually in the context of running a business. Okay, so these ones are going to be capital loss, because any investment that is made with the intention of getting some return back. Okay, it's not a business that we are into. It's more of an investment. So you take that as a capital loss or capital gains and all. So there could be loss on deposits when a bank usually filing bankruptcy or all, or maybe the institution becomes insolvent, they cannot pay off and all. So there could be a loss on deposits. Then if you are taking it as a personal casualty loss, it is not deductible. There is specific areas where you can put in that loss. Instead of doing that, take that as a capital loss or something which is deductible, but there could be a $3,000 limit on it. That maybe you can take only $3,000 every year. But capital losses can be offset against capital gains. If the person doesn't have gains, then they can claim only $3,000 a year, and rest can be carried forward. Okay, business gift. Any business gifts, again, these are very regular items and all. There could be some, practice in certain business that this time of the year we give gifts, or maybe some kind of regional practice and all at the time of Christmas or Diwali or New Year or something. So those gifts, or just general parties and all, so those are deductible, but there is a limit on it. It's just $25 per recipient. If you're giving like $400, $500 gift, then IRS doesn't allow that, because then it doesn't. Gift has to be like a token or something, right? It cannot be a very huge amount. Then you better consider that as a bonus and make sure that it is being taxed in the hands of the employee. So as long as it is reasonable, below $25, that's pretty okay. But again, we need to check on the limit. Probably it has been increased to 30 or 35 now. Okay, and that's fine. Spouses are treated as one taxpayer. This is $25 per recipient. So we cannot say one is given to husband and one is given to wife and all. So unless they both are working there in the separate capacity and they both are like, working for the same organization and all, then it's different. Then they are treated as two employees, not like before being spouses, they're treated as employees of the company. Any employment achievement awards, we have seen this. Who remembers this? I'll give a hint. $400 per employee can be given as an award. So who remembers? Anurag, do you remember? So there's a $400. We already talked about it. And if it's a qualified plan, the limit is $1,600. What is the qualified plan? We already talked about it, not once, but at least 2 times. There has to be a plan in place. It has to be writing. There should not be any discrimination. It has to particularly lay down all the conditions. When does the employee gets an award and all everything in writing and all, it should be pretty consistent for everyone in the company. Then even the limit has been raised to $1,600. So if an employee receives something for $1,600, it's not considered as an income. Otherwise, if you don't have any plan, usually small companies will not have, because it all costs. They'll have to go to an attorney, get the plan drafted and all, and maybe it's not really worth it for them. So usually they'll go with $400 limit. Depreciation, obviously depreciation is a deductible expense. As in business, you can take depreciation. If you're having a rental income, you can take depreciation. Okay. What is the percentage of depreciation? That what they're saying is we will discuss it in detail later on, because every category of asset may have different depreciation rules. On top of that, there's something called bonus depreciation, accelerated depreciation. There's some incentives which are given by IRS to a taxpayer, saying that instead of writing it off over a period of 7 years or 10 years, we allow you to take all the expense in next 1 year only or 2 years. Every taxpayer is going to welcome that, because from their pocket, the money has gone out. They've already bought the fixed asset. But if they have to wait for 5 years to depreciate it and claim a deduction, I mean, they are getting the benefits of tax savings over a period of 5 years when the expense has been made in very first year. So if IRS can give them some incentive saying that, okay, if you are putting money back into the economy, you are planning to buy a big, huge machinery or something, you're spending like $20,000, $50,000, we'll make sure you get the depreciation deduction in 1 year only. So we need to know what are those incentives. Can they claim for it? What are the conditions for it? Does it has to be a new asset? Can it be a used asset? Okay, all those section 179, a lot of things are there. That we'll discuss in detail later. So again, this is definitely an item which is a big difference between books and tax. As per books, you have to follow whatever the financial accounting rules are, or whatever the standard says. There are accounting standards that are set up by every board of accountancy, be it the Institute of Chartered Accountants of India or California Board of Accountancy or something else. They have their own standards, AICPA and all. So as per that, when we are writing an audit report, we can follow those standards. But when we are doing the tax filing, we have to see what is allowed by IRS. Okay, so it's not like, hey, IRS allows full depreciation, I'm going to take it in my books also. Auditors may not like it. Okay, next, startup cost. Please pay attention, everyone. We really need to make sure that you're all getting this thing. Again, this is an important point. Startup cost. Most of our clients are startup. So in the very first year, how much can they take as an expense? Sometimes, a lot of times the expenses are very high in the very first year, because they may have to go around, do some research, or maybe create a business, put in a lot of money, or maybe go and acquire a small business. So those acquisition costs and all, or it could be high. So what IRS is saying, $5,000 straight away you can take as startup cost in the year in which the business begins. So the year of, typically that would be the year of incorporation, but if you can prove that I incorporated but actually never began any business until next year, we can also take that for the, actually for the year in which the business has started. So any other expenses which is more than $5,000, you'll have to amortize it. There are companies who are spending like $50,000, $100,000 very first year itself. A lot of investment they may do. Maybe buy some huge servers and all if you're talking about tech companies, or if you're talking about some manufacturing companies, maybe do the entire setup, put up the factory and all that stuff and all. So what IRS is saying, $5,000 is a very reasonable, take it all as an expense. Anything above that, you amortize it, and you amortize it over a period of 15 years. So now we need to understand what is startup cost and what is the regular cost. The regular repairs, maintenance cost, accounting cost, management cost, and all those are regular. Those will be incurred every year. Those are not the first year organizational cost. Okay, so we need to understand that may differ from case to case basis, but generally the rule is 5,000, there's no issue at all. Above 5,000, amortize it. And in the very first year, you can take 5,000 plus 1/15 of the amount that you're going to amortize. Okay. Any questions here? Otherwise, we'll keep moving. Okay, reforestation cost. Lot of this is more of an environmental, incentive that the companies, they may plant some trees around their offices or factories and all. So what IRS is saying that definitely they're going to encourage that kind of activity and say that okay, you up to $10,000 you can take that as an expense. Any remaining balance, amortize it over a period of 7 years. 10,000 also is a big amount, so they are straight away saying, although like the life of the tree is only for 1 year. So they cannot say that, oh, if you're planting the trees, maybe for next 20 years, it's going to give you benefits. So you spread it over a period of 20 years. Because this is more of a good kind of expense, a merit, something to benefit to the society. So it's saying $10,000 per year you can take, no problem. Remaining balance, take it over a period of 7 years. Any vacant land, yes, interest and taxes on vacant land are deductible. Like maybe you've got the land, but still no activity has started, but we can still take a deduction. Any demolition cost and all, like anything has been, that's also 1 minute. If structure is demolished, cost and all, that typically they will be allocated to the land. That's what they're saying. So that would increase the basis of the land. And similarly, if you're creating something, if you're building something on the land, that will again add to the basis because now we are building a structure. Any abandoned asset that is actually, you can, it's deductible in the year the assets are actually abandoned and all, like, I mean, this scrapping out and all those things. Cost of goods sold, we already know what is the formula for cost of goods sold. Sales minus COGS is gross income. Any medical reimbursement plan, yes, that's also going to be deductible because that's again a very regular practice that all those benefits are given. Okay? Political contribution, those are not deductible. If that was the case, companies, huge companies will like pay millions of dollars, especially pharma companies. If some or maybe some other, car companies and all. If any of the political parties, is like promising them to make some, rules in their favor or bring them some tax incentive and all, why would not? They would probably make, they are making like hundreds of millions or billions, so maybe they'll give away 5-10 millions to the parties as donation. Those are definitely not deductible. Okay, any kind of political contribution is not deductible. Any lobbying activities and all, again, those are not deductible. Very small cost, what they're saying, $1,000 can be deductible, but usually those are all considered to be related with politics and all, so those are not. Payment of a debt of another party, we cannot come and say, hey, I had to pay debt for this person because being my friend or whatever. Like, yeah, debt of another, we obviously we cannot take that as an expense. But if what we need to see is there a business reason behind it? If paying off somebody else's debts helps in your business, or if there is some other business motive you have, and we can explain it that this is why we did, maybe it's a deductible expense. Okay, like maybe the supplier is filing bankruptcy and all, but you really have placed a big order with that supplier, and if they file the bankruptcy, everything would be gone. Maybe you can like help and pay some extra amount and say that, okay, I'll pay something extra, take care of your debts and all, but make sure our order is not cancelled. Okay, maybe if there is a business reason, it's allowed, but usually, you cannot go ahead and just say that I'm gonna pay off debt of this person, that person. That becomes more of a charity or donation and all. Again, that is not deductible unless you're making donation to a approved organization. Okay. Intangibles, yes, there could be a patent cost, there could be some intellectual property acquisition, technology improvement, whatever, they all need to be capitalized. Goodwill cost and all, we need to capitalize them. Tax exempt income, any income which itself is tax exempt, we cannot take an expense against it. So if there is a tax exempt interest or some other income, then we cannot say, oh, in order to earn the tax exempt income, I have to, make sure these expenses are paid out. So let me take a deduction. Obviously, again, that's very commonsensical. IRS will come and say, first pay off the tax on this income, then claim deduction. You're not even paying taxes. How can we give a deduction? Anything against the public policy, anything which kind of disturbs the public policy is not going to be an admissible deduction. There could be a lot of examples for this: illegal bribes, kickbacks, any damages for violation, illegal drugs, and all those things. Although one may come and say this is very ordinary and reasonable expense, we have to do this in order to stay in the business. So this is ordinary, this is necessary, this is reasonable. But again, at the end of the day, this is all illegal. So IRS is not going to allow that as a deduction. At the same time, if you're having illegal income, IRS will make sure you're being charged tax on that. Right? Because you cannot come and say, hey, the illegal expense is not allowed, illegal income. Yes, I'm having illegal income. I'll deal with police separately, but as far as IRS is considered, we don't want to pay any taxes because this is illegal. That doesn't work, right? It's just one-sided rules that they come up with. So they're like, fine, income, whatever it is, legal, illegal, make sure you're paying taxes. And any other expenses which are violating public policy, obviously there'll be no deduction allowed. Any impairment related expenses, if they're handicapped people working, or if they need any extra kind of support system in the office, like they'll be in US, it's a law that every office has to have a ramp. You cannot just have stairs there. The ramp has to be there so the person who is sitting in the wheelchair can take the chair right inside the office. Whatever building it is and all, or even like an apartment society also, not just a business place. Everything has to have a ramp if they are expecting the public to come in and go. So those kind of expenses, or if we know in the office somebody is like, is not able to work like a normal person would do because of certain physical restrictions, and if you're maybe creating a structure or putting some special table or chair or something else that helps that person, then all those are deductible expenses because it is all required for that individual to work there comfortably. Any other miscellaneous expenses? Yes, there could be office supplies, advertisement, and also, again, we need to take a decision. We need to use our professional judgment. What can be taken as a deduction, what not. We also need to understand from taxpayer point of view, as well as from IRS point of view, is that going to be admissible to IRS? From taxpayer point of view, is taxpayer genuinely claiming that as an expense? I mean, do they really have a choice there? Okay. Any kind of penalties, a lot of times, if you're withdrawing the interest income, let's say you're breaking your CD, or they call it CD in US, not FDs. So if you're breaking it, if it's a 1-year CD, 2-year CD, and if you're breaking it ahead of time, there might be some penalties and all that they may charge. So those are all deductible against that income, or you can also take it as a deduction separately above the line. Yeah, any business use of home, that's interesting. A lot of, especially that was very much relevant during lockdown times. Most of the people were, most of the employees were using their homes. So what can be reimbursed, what not? There are very, very specific rules around it. Otherwise, people would go and they take their entire rent expense saying that, yeah, I want to claim all of that. I'm working from home. Or all those kind of expense. So obviously that is not allowed. We have to see what is reasonable. We have to make sure the personal element has been carved out. And what IRS says is there has to be that portion of the home must be a principal place of business. You cannot say, okay, right now I want to sit in living room, then I'll sit in dining table, then I'll sit in the kitchen and I'll work, I'll sit somewhere else. No, there has to be a designated place that, okay, this is going to be my office room, this is my desk. And that's very easy to explain if let's say if a lawyer is practicing from home, so maybe one portion of the home is turned into office, or if there are doctors doing that, or if there is school which has been open in the home, or if there's a daycare, because we know that's a specific place, we cannot keep changing it. That's what, in fact, there have been some audit cases where IRS has actually asked for the pictures of home office. Show us the pictures, prove that you're always there. The pictures should be dated different timings and different time of the year. Prove it that this is a designated place and that's where you're working every day, like how you would work in the office. So exclusive use test is there. It has to be exclusively used. Okay. But there are two exceptions. A retail wholesale, maybe a person can just use the home or one room in the home to store the products. Okay, so that is fine. The second is like any daycare and all. If the business portion is used to offer daycare, but at the other time, maybe you're also using it for personal purpose. So those are okay. So and again, this is very, very common. Clients will come and tell us, oh, I'm using my home, I want to claim this much, that much expense, and they'll come up with a huge amount. So the reasonable question is, if you were not working from home, would you not incur expense? You would still incur, right? So how does that become as a deduction? Quite possible that, okay, now earlier you were probably in a 2-bedroom home, now you move to 3-bedroom because you need one extra room and all those things. In that case, yes, I mean, there is a reasonableness there. So what is that extra that you are paying? What is that extra that you've incurred to get furniture, lamps, lights, fixtures done, computers, or some electric wiring done, and all those things? So those are all deductible expense. But just coming and saying I'm like paying $3,000 every month for rent, I'm using the home for, office purpose. I want to claim at least $2,000 every month. Doesn't make any sense unless you can prove that there is a, that you have clients coming in, you have employees working from your home, or there is a specific place which is like, say, 1 or 2 rooms as only for that purpose. Then it's a different thing. Then we can say that, okay, this is a principal place of business, which is very commonly done with, lawyers will do that, doctors will do that, and all those things. Okay, we will go through these examples. So again, a home office has to qualify as a principal place of business. So principal place of business meaning some administrative management activities need to be done from there. Some, decisions need to be made over there. We cannot say that, okay, I already have a principal place of business as my office, but still I would go home and I would do, all the administrative functions from home. That's not allowed. There is a place, there is something called office, so go and work from there. Or you can work from home, but you don't claim that as an expense. If you don't have a primary place of business and we are frequently meeting employees or our agents or our vendors or brokers and all, you frequently meeting them at your own home, right? Like the real estate brokers, they may not have, but then they may have clients come to their home or they may meet other person. Then that's different. There's no other principal place of business, so that the home can be considered. Then we will go over this, what deductions can be allowed, what not, and all. But there is something called, we should all know there's something called simplified safe harbor method. Tanya, you are an expert on that. Can you explain this? What is simplified safe harbor method when we're talking about home office expense, and how can one use that?
So we take the whole measure of the house.
Okay.
And we allocate certain percentage that is used for business purpose, and typically a maximum deduction of 1500 comes for using the house as a or home office.
Yeah, so it's $5 per square feet. So it's $300 is, 300 square feet area if you're using for office purpose in your home. Then you straight away go ahead and claim 300 times 5. It's 1500 is what IRS is saying. It's a simplified method. No questions asked. Just go ahead and take that as an expense. But if you say, well, 1500 is too less for me, I'm spending much more than that, then IRS will also allow you that, okay, then fill up a very, like a huge big form of all home office expense. Tell what is the percentage that should be applied towards personal and towards business needs and all, and then you claim more than that. Okay, but then in that case, you need to have a very good record keeping and all, and you need to be prepared. If there is any audit, you need to be able to prove everything. So, who can Sakshi start reading it, or Anurag? Then we'll go.
Yes, ma'am. Um, Percy signed the contract to sell Penny 100 widgets for $2,500 to be delivered on April 1. Percy must pay a $10 fine per unit for each week the shipment is late. In March, Percy received and accepted a $5,000 order from Mark for the 100 widgets that was set aside for Penny. Because Percy decided to sell the 100 widgets to Mark, he was only able to deliver 50 widgets to Penny on April 1 and delivered the remaining 50 widgets on April 5. Percy paid Penny a $500 late shipment fine. The $500 fine is tax deductible because it was a business decision and not paid to a government for violating a law.
Good. Please explain, Sakshi.
Uh, Ma'am, these fines are related to business. That's why they are deductible. I guess it is so.
It's an important thing. They are not violating any law,
Okay.
correct?
Okay, ma'am.
That's why they're deductible. If we are not paying GST in time, we are violating the law and we are incurring a penalty or something, those are not deductible as an expense. Okay? Okay. Rohit from Indore.
A taxpayer use part of their home exclusively and regularly to read financial prediction and reports, clip bond and coupons, and carry out similar activity related to the taxpayers on investments. The taxpayer does not make investment as a broker or dealer. These activities do not qualify as a part of a trade or business and disqualify the home space for a reduction.
Ma'am, can I ask?
Yeah, please go ahead.
Ma'am, it's related to taxpayers' own investments. Uh, so it is not a part of business or trade. So, there would be a deduction.
Right, right, because he's not a trader or a broker or anything, right? This is a passive trader just to be aware of what's happening and all. They want to read the financial periodicals and all. So that is not going to be, we cannot say "Oh, every day I sit in my veranda and I'm reading economic times and financial times to make sure that I can make proper investment calls on what equity or what bond to invest in. That's not allowed because this person is not a broker or trader or something, okay, or dealer. Continue reading now. Is Hemant there?
Yes, ma'am.
3.17.
Brennan owns a Fisher company which does not have a physical office, has a five people. Once a month, Brennan meets with the sales team and spare a bedroom in his house that is used to conference room. The only activity that occurs in the conference room are monthly meetings and administrative functions of Fisher Company. So conference room treated as a home office.
Yeah, so the big point there is no other office the company has. Everybody is probably working remotely or there are salespeople who are always on field. They need a place to meet, maybe just once a month or maybe 3 times a month or 4 times a month. So that can be taken as a principal place of business. So one room in his house can be taken, and then accordingly the expenses related to that room can be taken as home office expense. Okay, Shweta, 3.18.
Tony has $10,000 of net income from a business activity conducted in a home office. The home office makes up 30% of the square footage of the home. Tony has mortgage interest and property taxes on the home of $20,000. Tony has 5,000 in insurance and utilities on the home. The maximum amount of depreciation deduction on the home office is 2,500. That is 10,000 minus 30% of. Okay, so 30% he is utilizing it for office purpose. So whatever expenses he is incurring, that is taxes and also insurance. So 30% of that and can be claimed as an expense. So his net income from business will be 10,000 minus 30% of the expenses, that is 2,500.
So what they're saying is 2,500 can be claimed as a maximum amount towards depreciation deduction because The deduction, it cannot go negative. It is limited. Deduction is limited to gross income derived from wages minus their expenses and all. Okay, so we cannot take that as a negative thing. So we have to see what is the gross income and all, and only that much can be taken as a deduction. Okay. It may allow you to carry forward your undeductible expenses, but we cannot go negative on that, especially for home office deductions. For other deductions, yeah, you can go even, you can, claim losses also. Understood?
Yes.
Same, like on the same lines, there's another example. So let's read this. You can even continue, Shweta.
Tammy has 32,000 of gross income from a business activity conducted in a home office. She may deduct $10,000 of mortgage interest and property taxes allocable to the home office as personal expenses. Tammy has 6,000 of home office expenses other than depreciation, 3,500 in depreciation, and 15,000 of business deductions that are not home office expenses. Only 1,000 of depreciation is deductible as home office expense.
Yeah, so can you explain what is happening here? This 32,000 is the gross income. What is that she can deduct?
She can deduct 10,000 of mortgage interest.
Because that much is allocated to home office.
Yeah, and
Then
also 15,000 of business deduction plus
that are
6,000,
not home office. That are not home office, right? So that 15,000 also can be taken.
and also 6,000 of home office expenses.
Right. So after deducting all of that, this is coming to 31,000.
Right.
So they are left with only 1,000. So even if the depreciation is 3,000, 4,000, IRS will only allow $1,000 depreciation, because depreciation is again related to home office. So in order of priority, if you want to see the business deduction that are not home office expense, they will go out first. Then other expenses can go out, and depreciation is the last. Depreciation gets limited to the extent of the revenues. But if you have 32,000 in gross income, and if you are having 35,000 of business deduction that are not home office, then you can definitely claim $3,000 loss. But if we are only claiming home office expense, we cannot make it go negative. Okay, if there is a limit that comes up. This is what they're saying here. Deduction for business use is limited. Okay. All right, then last one. Okay, now this one is something, Honey, you want to go ahead and read?
Yes, ma'am.
3.20.
Yeah. Kathleen is employed as a teacher. She is required to teach and meet with students at the school and to grade papers and tests. The school provides her with a small office where she can work on her lesson plans, grade papers, and tests, and meet with parents and students. The school does not require her to work at home. Kathleen prefers to use the office she has set up in her home and does not use the one provided by the school. She uses this home office exclusively and regularly for the administrative duties of her teaching job. Kathleen cannot claim a deduction for the business use of her home because, first reason, the home office is not for the convenience of the employer, and the home office deduction is not available to the employees. So she will not be able to claim office expense as a deduction because the school itself is providing her a space for office purpose, and she's using her home office for her convenience. So that is one
Right,
reason.
right.
And yeah, and the other
Yes, so
reason.
IRS will not allow that as an expense because there is a principal place of business which has been provided to her. If she did not have any other office, any other place, then she chooses to work, or the employer says, well, we don't have an office, you just continue working from your home, then that's a different thing. Okay?
Yes, ma'am.
Because as per IRS, that is not an expense which is needed. IRS is already giving a deduction for school expenses. So IRS thinks that okay, there is a school, there is an office that you provided, you work from there. If you don't want to work from there, you can work from anywhere you want to, but we will not allow that as a deduction. Right? So hope that's clear now. What home office expenses can be claimed, what not, and all. So same thing if a client comes to us and says, I have a home office, we need to ask, like, are you really required to work from home? Is that for your choice, or you are doing it for your own convenience? Or there is a proper office given by the employer, but you're choosing to work from home. Then it's different. Okay? Any questions? Anyone? Otherwise, we'll close for here.